Thanks for tuning in to Talking Point. I'm your host, Niraj Shah, and our guest today is Prateek Agrawal, Executive Director of Motilal Oswal AMC. The case for a chat with Prateek Agrawal naturally veers around whether India continues to remain in a spotlight in 2024. Within that, does the regulatory action or the spate of regulatory actions recently deter the investor mood? Key question pertinent to ask. And of course, the last 4 days or 5 days, we've started to see the small caps in particular starting to underperform the large caps. Is this just the beginning of that phenomenon? Prateek, great having you. Thanks for taking the time out. I hope all is well. Prateek, let's start off with the more pertinent question, which is in the minds of everybody, because we've been talking about how large cap valuations seemed relatively much better than mid caps and small caps. The last 5-6 days, at least, if not longer, we're starting to see that bout of underperformance creep into the small cap space. Is this just the beginning? Do you think there is more to go before the valuations sanity comes into play?
No, sure. So, as long-term investors, the lower the better. That said, but we were actually deliberating on the same. Now, if you look into what goes into valuations, it is not the size of the company. It is basically, the growth of the company in cash flows and the discount rate that one applies. Now, the big change is, are you there?
Can hear you loud and clear.
Yeah, so the big change is that, after 2020, bottom of COVID, the small and mid have seen earnings growth, which is significantly higher than large. Now, ballpark, a percent higher earnings growth should result in 2% higher valuations of a particular space. And hence we say that if the growth delta of mid and small continues to be significant versus large, the premiumness should sustain. Yes, the riskiness associated with this space on account of lower liquidity remains. So that's a risk that you are taking versus a more liquid, generally speaking, large cap space. But for a 5% growth delta that we believe could sustain going forward, given that this is a whole new ecosystem coming up in many, many spaces, versus earlier when these spaces used to trade at a discount to large cap, thought is that it could continue to trade at a premium to large cap. The only thing is the growth delta should continue to sustain.
Okay. A lot of these themes which are showing this growth delta, Prateek, are themes which are maybe benefiting from, I mean, these are sectors which have come to the fore, especially in the SMID space at the recent past. Some of them are not present in the large cap space. The China Plus One benefits are going to some of these companies quite clearly, which are not there in the large cap space as well. Do you reckon that these near-term concerns notwithstanding, the SMIDs are still the pocket wherein the creation of alpha has a high probability?
No, so the short answer is yes.
Okay.
So if you are a long period investor, don't come into this space for momentum.
Right.
But if you're a long period investor, then this space should see earnings growth way higher for the same reason that you are saying. Many of the growth themes are predominantly present here. So longevity of growth is here. A lot of new businesses, new business lines are coming up, something which wasn't there in the country, let's say 2-3 years back. So all of them present in this space, longevity of growth is there. So if you are a long-term investor, this is a space which should continue to deliver alpha.
Now, your presentation, Prateek, the note that comes in from your desk has some very interesting thoughts. And one of the things that stood out for me was you saying that the highest quality and the highest growth sector wouldn't be the same always. Now, could you explain this point to us?
No, so, let's look at this period, 2000 to 2021 and beyond. Okay, now 2000 to 2008 is one period. 2008 to 2021 is next period. I'm not taking bottom of COVID, which is 2020, I'm taking 21. And 21 and beyond is another period. Now, if you look at 8 to 20, the large cap index earnings growth was 5%, ballpark. Mid caps you thought would grow faster than large, but actually the earnings growth of the mid cap index was 4%. And the small cap index was 2.8%. Okay, so this was a period which saw a lot of disruptions for various counts, and we all know that. Starting from Lehman and ending with COVID, in between taper tantrums, etc., etc. Now, the highest quality part of the market, let's take a consumer index, delivered earnings growth in this period at 12%. So this is the highest quality part of the market, and incidentally, in this very long period, also delivered the highest earnings growth. Now that has changed. So index itself after 21 has been growing earnings at a clip beyond 20%. Even in the last quarter was 17%. And even if one assumes that consumers continue to do what they were doing, they are now delivering earnings growth significantly lower than that of the broad index itself. So they are no longer the growth leaders. Is the key thought. For some space which has done so well over 13, 14 years, it takes the connotation of quality did very well, quality does very well. It may actually be that growth did very well. Growth always does very well. In this 8 to 21 period, the highest quality part was also the highest growth part, and which is not the case in 21 and beyond period, wherein all of these newer spaces have come up. They are delivering growth vastly in excess of the index itself, and index itself is delivering earnings growth which is higher than, let's say, the consumer part of the market. I'm using consumers repeatedly just to say that this is the highest quality part in the market as measured by an indicator like return on capital employed. So if one holds the thought that earnings growth is where markets ultimately go to, it went to the highest quality part in 8 to 21. For example, a 12% compounding of earnings in a consumer index ended up with a 15% compounding of the index itself. And now, when the let's say Nifty earnings is higher than that of consumer, the opposite is true. And when a mid cap and small cap earnings is higher than Nifty itself, those are doing better. This is one. Second, continuing on the first question that you asked me, in the 8 to 21 period, there was no period wherein the mid and small had consecutive years of growth. 3 consecutive years of growth were not present. Both mid and small had one instance of 2 consecutive growth years. So, you start to look at a place, a space, you make up your mind to go there, and by the time monies get positioned there, the earnings growth simply evaporated. So, and when I speak, a lot of what happened in that period would come back to the fore. You actually saw a bet in the mid and the small space hurt you massively in that period. Now, from 20 onwards, if one takes 20 base of COVID, you've got 4 years of increase in earnings now. 24, just one quarter is left. Mostly, it will be a good, nice growth over 23. So, which is what is feeding into sustained performance of this space. So, if growth sustains, I think valuations and performance should come. Uh, when I then compare this, so by the way, the highest quality part didn't perform in the 2000 to 2008 period. So, what are the similarities of the current period with 2000 to 2008? Before 2000, you saw a burst of reforms. 2000 to 2008, you saw capex-led growth. Gross fixed capital formation increased for 8 years from, if I remember right, 2.7 as a percentage of GDP to 3.5%. The start point again is very similar. We have seen 3 years of growth. We had a huge dollop of reforms just before, and they continue. So we have, or one should assume, we should have at least 4 or 5 years more of growth, of apex driven growth going forward. Now, in 2000 to 2008, again, this highest quality part didn't perform, if one takes the consumers part of the market. And we hence believe the same could be true in this part, in this period as well. Now, the key difference is 2000 to 2008 was a period of debt, which hurt companies hell of a lot in the post-Lehman period. Now, this time around, the part which is doing well has very sustainable level of debt, if at all, 30% debt equity or lower is the usual thing that one experiences. So, in many cases, in many ways, this period, the mid and small are not what was the case earlier.
Prateek, some of the uh, India numbers seem to be pretty strong. I mean, port volumes for select companies may be one. Some of the growth numbers, I mean, the Indian GDP number itself is looking so strong. What's happening here? And are you inclined to have a larger exposure to India domestic inward facing sectors as opposed to relatively as opposed to the export facing sectors?
The short answer is yes. And the thought is that if India is the bright spot in the world for growth, and we are growth focused investors, larger part of the monies, practically all of the monies, should be focused on Indian businesses. So which is what it is. So as a part of risk control, some of the export oriented businesses are large in the index. So we do have some presence in spaces like IT, but otherwise our portfolios are dominated by domestic focused businesses.
Now, Prateek, tell me, sorry, so just a segue, are export-facing businesses currently available at valuations where starting to nibble selectively might be a good idea, or that is ruled out completely?
So it depends on what is it, how are you going to build your portfolios? This question is best put to a value focused guy. We are out and out growth focused in today's market, given what is happening, given how the opportunities are being thrown up. We believe, our portfolios reflect growth like no other portfolio. So that when you say, then in the larger export focused spaces, chances are that you would have a growth in EPS number which is trailing that of the index itself, and that is our reason to be not there, save for risk control. So we have some tolerances of how much we can deviate from the index. So, basis that some exposure may be there, else not. So that is how it is. But yeah, there are some export oriented businesses which may have tailwinds. So, for example, if US wants to source or disengage their sourcing away from China, in certain spaces, Indian businesses get benefited strongly. It could be solar panels, for example. So that's a space that we are focused on. Now, the country is also signing double taxation free trade agreements with European bloc. So we signed it with 4 countries. Those are small, but maybe when the larger part of the eurozone and Britain get signed over the next period, it could open up good, nice export-oriented opportunities for our businesses. So it can change, and we are clued on. But when you look at us, think growth. Think if a space offers more growth than the index for next several years, chances are you will find us there.
Got it. Okay. There is, from all the newer spaces, Prateek, that have come to the fore, there are companies which are now setting up semiconductor manufacturing facilities or doing tie-ups for those, which is very interesting. PLI schemes for a whole lot of new sectors have come to the fore as well. What has stood out for you as something that is got the highest longevity of growth? I mean, the near-term growth aspects may not be very clear, but the longevity aspect is probably more clear.
No, in many spaces, longevity is quite how should I say, long. Longevity is long. अच्छा ठीक है.
Yeah, well.
No, for example, spaces where government policy is not the tailwind, but maybe changing demographics of the country is. So yes, we are a young country, but versus 10% of the population today, which is sub 60 years old, 20% of the population will be over 60 in 20 years. Uh, and when that happens, well, the need for healthcare will increase. I mean, I keep saying this is a generation which has accumulated wealth versus the earlier generation and slogged their way through their lives. So chances are when these guys get old, I will get old by then. We would want better quality healthcare to be there. So things like hospitals, you feel the need of it all around you, except maybe in certain small pockets where public infrastructure is very strong. The rest of the country you need. I mean, in Bombay, given how traffic is, even for the best of localities in South Bombay or there is no way you can reach anything in time. So the need is very, very palpable. So is one thing. Second, of course, manufacturing as a part of policy, Make in India, etc., will have a large, long runway of growth. Now, manufacturing of stuff which used to always happen in India will grow, yes, but newer stuff is getting added to it. Newer stuff in many ways has strategic importance as well. The good thing is while a lot of this new stuff left on its own may not be very high ROC businesses, but with the helping hand of the government, these businesses are making a lot of sense for people who are able to get the benefits and put those facilities up. Now, the runway of growth is super long. The Indian market itself is large. And if we are able to export a significant part of what gets done here, the opportunity can be very large and sustainable for several years. Then, on the same theme of India getting richer, anything luxury consumption, hotels, etc., should all do well for longer. Challenge here in some of these spaces is regulations for sure.
Got it. Okay. And point well taken, but unfortunately, out of time completely, so we'll have to wrap it up here. But Prateek Agrawal, thanks for taking the time out and being with us today.
Thank you.
And
Have a good
thank you. And viewers, thanks for tuning in.